Picture two men at a dinner party in 1920s, New York. One has $4 million sitting in a bank account. The other has $40,000 in cash and a standing invitation to every country club, every hunting lodge, every board meeting that matters from Boston to Newport. He is on a first-name basis with 3 senators, godfather to the children of 2 industrialists, and his daughter is engaged to a young man whose family controls a shipping line. Ask any modern financial advisor which man is richer, and they'll point to the bank account without hesitation. Ask any family that has held wealth for 4 generations, and they will tell you, quietly, because this is not the kind of thing old money says out loud, that the second man is the wealthy one. The first man is simply holding cash. This isn't hidden. It's just never taught. Every personal finance channel on this platform will tell you to build liquid assets, cash, stocks, bonds, things you can convert to money on a Tuesday afternoon. And for the first generation of wealth, that advice is correct. But somewhere between the first fortune and the fourth, something changes. The families who successfully transmit wealth across a century stop optimizing for liquidity and start optimizing for something almost invisible, who owes them a favor, who trusts their word, and whose children will marry theirs. This is the actual mechanism behind generational wealth survival, not tax law, not investment returns, but a currency with no ticker symbol. Sociologists call it social capital. Old money families never called it anything. They just built it, generation after generation, as carefully as any stock portfolio. And today, we're going to take it apart, mechanism by mechanism, and show you exactly how it works, why liquid wealth alone fails without it, and how this architecture is built, brick by brick, from the marriage bed to the boardroom. Let's get into it. The economist who named what aristocrats already knew. In 1986, French sociologist Pierre Bourdieu published an essay that gave old money's oldest trick a name it had never needed before: social capital. Bourdieu's argument, stripped of academic language, was simple. Capital doesn't only come in the form of money, it also comes in the form of durable networks of mutual acquaintance and recognition. Relationships that can be converted into economic advantage precisely because the people inside the network trust each other enough to extend credit, opportunity, and information that they would never extend to a stranger. The critical insight, and the one that separates old money thinking from first-generation wealth thinking, is that social capital compounds differently than money does. Cash sitting in an account earns interest at a fixed published rate. A relationship built over 30 years of reciprocal favors, discretion, and shared institutional membership earns something no bank offers: access that cannot be purchased at any price, by anyone, at any moment. You cannot walk into a private equity deal with a check the size of a founding partner's if you are a stranger to the room. You can walk into that same deal with half the capital if the founding partner went to boarding school with your father. This is why old money families have historically under-indexed on visible liquid wealth relative to what an outsider would expect, and over-indexed on institutional memberships, marriage alliances, and multi-generational friendships that read, on a balance sheet, as nothing at all. Economist Mark Granovetter's 1973 research on social networks, The Strength of Weak Ties, adds the second half of the mechanism. Granovetter found that the most valuable information and opportunity in someone's life rarely comes from close family or best friends, who tend to know the same things you already know. It comes from loose acquaintances who move in different circles, the golf partner, the fellow board member, the fraternity brother from 3 decades ago. Old money families don't just cultivate deep ties within the family. They deliberately cultivate wide, loose ties across other wealthy families, precisely because that is where deal flow, marriage prospects, and political intelligence actually travel. This is the first mechanism of the silent currency. Social capital is not sentimental. It is structural. It is built the same way a stock portfolio is built, deliberately, with diversification, and with a multi-decade time horizon. If this framework is new to you, the idea that relationships are underwriting instruments, not just friendships, you are exactly who this channel is for. Subscribe now, because the next 6 sections build directly on this foundation, and by the end of this video, you'll understand exactly why a family with less cash and a stronger network will outlast a family with more cash and no network every single time. The marriage alliance, capital with a wedding ring. No institution in old money history illustrates social capital more precisely than the marriage alliance, and no family illustrates the marriage alliance more precisely than the Rothschilds. By the mid-19th century, the Rothschild banking dynasty had spread 5 brothers across 5 European capitals: Frankfurt, London, Paris, Vienna, and Naples. This gave the family extraordinary financial reach, but it created an obvious vulnerability. 5 separate branches, 5 separate sets of heirs, and the very real risk that the family's capital and information network would fragment across generations through marriages into outside families. The Rothschild solution was cousin marriage, a documented and extensively studied pattern. Of 18 marriages of Mayer Amschel Rothschild's grandchildren, at least half were between first or second cousins. This wasn't romantic accident. It was capital preservation through kinship engineering. The historian Niall Ferguson noted the family's fortune was in some measure a fortune begat by inbreeding, in the sense that the marriages functioned to concentrate capital and shared banking intelligence inside a closed circle, rather than dispersing it to outside families. The mechanism here is worth stating plainly, because it is the same mechanism operating in softer form in old money marriages today. A marriage between 2 families that both hold capital does not just merge 2 people. It merges 2 networks. It merges access to 2 sets of business relationships, 2 sets of political connections, 2 sets of institutional memberships, and, critically, 2 sets of discretion. Both families now have equal incentive to protect the reputation of the union, because reputational damage to one side damages the shared network both sides depend on. This is why, historically, elite marriage was never primarily about romantic compatibility, a fact modern audiences find uncomfortable, but which the historical record supports without ambiguity. Genealogical and historical scholarship on European and American dynastic families consistently shows marriage functioning as a capital allocation mechanism, consolidating land, banking relationships, industrial holdings, and political alliances across generations, with romantic attachment treated as a secondary, sometimes irrelevant, consideration. American old money adapted the same logic through a different mechanism. The debutante system, the formal presentation of young women from wealthy families to society at events like the Fifth Avenue Cotillions or the International Debutante Ball, was never simply a coming-of-age ceremony. It was a curated marriage market designed to ensure that eligible daughters of established families met, and only met, eligible sons of comparably established families, under supervised conditions that filtered out mismatched unions before they could begin. The uncomfortable modern parallel, today's equivalent, isn't a formal debutante ball. It's the exclusive boarding school, the same 3 universities, the same 6 social clubs, and the same 12 philanthropic boards. Institutions engineered, whether consciously or through decades of self-selecting tradition, to put the sons and daughters of capital in the same rooms as each other and almost nowhere else. Fact-check flag. The inbreeding framing from Ferguson's account should be presented carefully on screen. It is a historian's documented characterization of a real pattern, not a claim that cousin marriage was universal or without consequence within the family. Present as historical record, not endorsement. The institutional pipeline, where networks are manufactured. If marriage consolidates capital between 2 families, the institutional pipeline is where social capital gets manufactured before marriage is even on the table. Starting as early as age 8, the elite boarding school is the first stage of this pipeline, and its function is frequently misunderstood by outsiders as being purely academic. Academic rigor is real, but it is not the primary product. The primary product is 12 years of shared physical proximity with the children of other capital-holding families, under conditions, dormitories, shared meals, mandatory extracurriculars, that manufacture the kind of loose, trust-bearing tie that Granovetter identified as the most economically valuable kind. A child who spends 4 years at a school like Groton, St. Paul's, or Phillips Exeter does not simply receive an education. They receive a cohort, a group of 30 to 60 peers who will, over the subsequent 50 years, become bank executives, federal judges, museum board chairs, and the inheritors of family offices. The value of this cohort is not activated at graduation. It is activated in year 25, when one member needs a discreet introduction to a private bank, and another member, now running that private bank's wealth division, takes the call not because of a marketing pitch, but because of a decade of shared dormitory life at age 14. The university tier compounds this. Legacy admissions policies at elite universities, practices that have drawn increasing public scrutiny, and, in several cases, formal policy reversal in recent years, historically functioned as a capital preservation mechanism disguised as an academic one, ensuring that the children of alumni families continued to occupy the same institutional spaces their parents and grandparents had occupied, reinforcing rather than diluting the network across generations. Then come the final year societies, the most mythologized and least understood layer of the pipeline. Groups like Yale's Skull and Bones function less as the secretive cabals of popular imagination and more as accelerated trust formation programs. Small cohorts of 15 or so students, selected specifically for family background and demonstrated ambition, who spend a final year of college in structured private meetings designed to build exactly the kind of deep, discreet, mutual obligation tie that pays dividends across an entire career. The society's actual secrets matter far less than the simple fact that 15 people now share one. This is the second mechanism of the silent currency. Institutions are not chosen for prestige. They are chosen for the specific, durable network they manufacture. And the manufacturing takes 12 to 16 years, starting in childhood, which is precisely why this form of capital cannot be purchased by a first-generation fortune, no matter how large. This is exactly the mechanism we mapped in our companion video on quiet education and apprenticeship versus prestigious degrees. Link in the description and pinned comment. If you want the full picture of how old money engineers advantage through institutions rather than income, that video is the essential second half of this one. Go watch it after this and hit that like button now, so this analysis reaches more people who've never had this explained to them plainly. The club economy, gatekeeping as an asset class. If institutions manufacture the network in childhood, private clubs maintain and monetize it in adulthood, and they do so through one of the most economically fascinating gatekeeping mechanisms ever developed: artificial scarcity by design, not by cost. A membership at an elite private club, a downtown business club, an exclusive golf club, a hunting club with a century of continuous membership, is rarely expensive relative to the wealth of its members. Initiation fees and dues, even at the most storied clubs, are a rounding error for anyone wealthy enough to be considered for membership. The actual gate is not price. It is sponsorship and blackball. Most elite clubs require existing members to sponsor new candidates, often multiple sponsors, and many retain a blackball system in which a single objecting member, voting anonymously, can permanently deny entry regardless of the candidate's wealth, credentials, or public standing. This inverts the normal logic of markets. In virtually every other economic context, money buys access. Inside the club economy, money is necessary but explicitly not sufficient. The actual currency of admission is the accumulated trust of the existing membership, extended on the candidate's behalf. The economic function this serves is significant and rarely stated aloud. The club functions as a screened information and deal flow environment. Business conducted in a boardroom carries legal formality, competitive posturing, and documentation. Business conversation carried out over a round of golf or a dinner table at a private club carries none of that friction, precisely because everyone in the room has already been vetted by the sponsorship and blackball system before the conversation ever begins. Old money families have long understood that the most valuable deal terms, the earliest access to a private placement, or the first word of a family's financial distress, travels through this pre-screened channel long before it would ever reach a public market or an open marketplace. This is precisely why old money views club membership not as a lifestyle expense, but as an active line item on the family's social balance sheet, renewed generationally, protected fiercely, and treated with the same seriousness as a trust structure, because in practical terms, it functions as one, a closed system that controls who gets access to the family's deal flow and whose deal flow the family gets access to in return. Interlocking directorates, the boardroom as a trust network. The most quantifiable form of elite social capital exists in a place most viewers will not expect: corporate board membership, and specifically the phenomenon researchers call the interlocking directorate. An interlocking directorate exists when the same individual sits on the boards of two or more separate companies simultaneously, creating a direct information and trust channel between those companies' leadership. Sociologists studying American corporate power throughout the 20th century, most notably in research tracing what became known as the inner circle of American capitalism, documented that a relatively small number of individuals, drawn overwhelmingly from old money and elite institutional backgrounds, held a disproportionate share of board seats across the largest American corporations and major nonprofit institutions, effectively forming a single interconnected network sitting atop the formal corporate structure. The mechanism matters more than the statistic. A board seat is not primarily compensation. Many prestigious board seats pay a fraction of what the individual's time is worth in pure market terms. A board seat is a standing appointment inside a trust network. The director gains early, non-public insight into the strategic direction, financial health, and succession planning of the company. The company gains the director's network, judgment, and, critically, the reputational endorsement that comes from an old money name agreeing to attach itself publicly to the enterprise. This is why old money families have historically prioritized placing family members on nonprofit and cultural institution boards, museum boards, hospital boards, university trustee boards, with a seriousness that puzzles outside observers, given that these positions are frequently unpaid and demand significant unpaid labor and donation commitments. The nonprofit board is not charity work in the way it is typically framed publicly. It is a lower friction entry point into the interlocking directorate system, one that builds the same trust relationships as a corporate board, often with corporate directors sitting on the very same nonprofit boards, creating a bridge between the philanthropic network and the commercial one. This is the third mechanism of the silent currency. Formal governance seats function as a visible, quantifiable proxy for an underlying trust network that is otherwise invisible from the outside, which is precisely why old money families track board seats across generations with the same discipline other families track stock portfolios. If you're finding value in seeing these mechanisms named explicitly, the things that are technically public record but functionally never explained, drop a comment telling us which mechanism surprised you most. We read every comment, and it directly shapes which mechanism gets the next deep dive treatment on this channel. Philanthropy as access currency, the gala, the naming gift, the foundation. To an outside observer, elite philanthropy looks like generosity. Inside old money's actual operating logic, philanthropy functions as one of the most efficient access purchasing mechanisms available, and understanding why requires separating the stated purpose of a charitable gift from its structural function. A major gift to a museum, university, or hospital typically buys three things simultaneously, only one of which is charitable impact. It buys naming rights and public reputational capital, a family name on a wing, a program, or a scholarship permanently associated with civic virtue rather than raw wealth accumulation. It buys institutional access, a seat at the gala, on the host committee, or eventually on the board itself, placing the family physically in rooms with other major donor families who occupy the same tier of the interlocking network described in the previous section. And it buys discretion and legitimacy. A wealthy family known primarily for large-scale, well-publicized philanthropy is subject to a different level of public and media scrutiny than one known primarily for large-scale accumulation. This is why old money philanthropic giving has historically clustered around a small number of highly visible, high-prestige institutions. A handful of major museums, a handful of Ivy League universities, a handful of flagship hospitals, rather than being distributed according to purely utilitarian measures of social impact per dollar. The concentration is not accidental. The prestige institution is the one whose donor rooms contain the other families worth being networked with. A gift of identical size to a less prestigious cause may do more objective good, but it does not open the same doors, because it does not place the family inside the same room as the other families whose deal flow, marriage prospects, and board seats matter to the giving family's multi-generational strategy. The gala circuit functions as the club economy's public-facing cousin, less exclusive on paper, Tickets can technically be purchased by anyone, but self-filtering in practice, since the price point and social expectations of attendance quietly exclude all but the same network of families who already know each other from boarding school, university, and the boardroom. This is the fourth mechanism of the silent currency. Philanthropy is simultaneously genuine and instrumental. The two are not in tension inside old money's actual practice, and understanding this dual function explains gift patterns that a purely charitable framework cannot. We've covered marriage, education, clubs, boards, and philanthropy. 5 separate mechanisms building one integrated network. If you want to see exactly how these mechanisms interlock at the family level across multiple generations, our full breakdown of family constitutions and governance frameworks is linked below. It's the practical machinery families use to formalize everything we've just described. Subscribe now if you haven't, because we're about to bring all 5 mechanisms together in the final section. Why liquid wealth alone fails. The synthesis. We can now return to the 2 men from the cold, open with the full mechanism in view. The man with liquid cash has a store of value. It is real, it is useful, and in a genuine emergency, it will outperform every mechanism described in this video, because cash can be deployed instantly and requires no one's cooperation. But a store of value is not by itself a generational transmission system. Cash sitting in an account does not introduce your grandchildren to their future spouses. It does not get your son a board seat. It does not get your daughter's foundation gift matched with an invitation to the museum's most influential committee. It does nothing to protect the family from the single greatest threat every fortune eventually faces: the erosion of relevance. This is the actual explanation behind the well-known statistic that a significant majority of family fortunes are substantially diminished or fully dissipated by the 3rd generation, a figure widely cited across wealth management literature, though one that should be flagged on screen as contested in its precise percentage and methodology across different studies. The conventional explanation blames poor financial literacy or lavish spending among heirs. The social capital lens adds a second, less discussed explanation. Families that fail to consciously transmit network capital alongside financial capital produce heirs who inherit money, but not the relationships that made the money durable in the first place. And a fortune without a network is a fortune with no defense against bad advice, no early warning of market shifts, no access to opportunities before they become public, and no social protection when the money runs into legal, reputational, or political headwinds. The families that succeed across 4, 5, 6 generations, the Rothschilds, the Rockefellers, the great banking and industrial dynasties whose names persist a century after their founding fortune was made, succeeded not because they simply invested their liquid capital more skillfully than everyone else, though disciplined investment mattered enormously. They succeeded because they built both currencies simultaneously and treated the invisible one with the same seriousness as the visible one. Marriage as capital consolidation, education as network manufacturing, clubs as screened deal flow environments, boards as formalized trust positions, and philanthropy as legitimized access. 5 mechanisms compounding quietly across generations, invisible to any balance sheet, and almost never discussed publicly by the families who depend on them. This is the actual architecture behind the phrase old money families use privately and almost never explained to outsiders. It was never about how much you have. It was always about who you know, who trusts you, and who is obligated to you before the money is ever mentioned at all. This isn't hidden, it's just never taught. If this video changed how you see the difference between wealth and money, that's exactly the kind of shift this channel exists to create. Subscribe and ring the notification bell. We'll see you in the next one.